lot just happened this past week.
All right, Matt, you know how much I love political questions.
Scott, loaded question.
In 6 weeks, we have a huge election in this country.
Today is Tuesday, September 24th, 2024, and this is The Bash. Welcome to The Bash, where we bring the analyst and planner to the table to discuss relevant financial and investment topics. We're going to have 60 seconds to discuss each topic. Scott, my man, the analyst, before we get started, any plans coming up for pumpkin picking? I know this is a great time of year. What's going on with you and the family?
Family's great. Thanks for asking. It is September 24th, but is it too early to say it is Red October season?
And the Phillies are National League Eastern Division champs.
All right, so we're just going to focus on playoff games. I just want to fast forward to Halloween because I love candy.
Okay, just to make it clear, if you're buying me a gift, I want candy.
But we're going to turn now to the markets, and a lot just happened this past week. So, Scott, I'm going to turn to you. The Federal Reserve decided last week to cut rates by 50 basis points. This was a historic move. The economy is clearly slowing. Am I right?
Well, you're right. It is a historic move, Matt. And I'm glad we're starting with this. The Fed did cut rates by 50 basis points last week. That's a historic move for the movement of interest rates. It has happened before in the past. And I think that investors really need to look at the underlying economic context. We need to better understand that is this rate cut the start of quite a few because of economic weakness, because of a soft patch in the economy, or because maybe the Fed wants to stimulate more growth?
Or because of them?
A lot is still to be determined. However, investors must look at a couple items. Number one, the short-term and long-term impact of equities and bonds. They should also be looking at their sectors that they're invested into. And then when they're looking at their income that they're earning from investments, you want to be aware that when rates are going down, owning that long end of the curve could be advantageous in bonds. So yeah, there's a lot of implications, Matt, to this rate cut. I don't think that we have answers quite yet. Only time will tell.
Scott, great points. And you just talked about the rate cut. But guess what happened? Jerome Powell spoke after the cut, and that's what I want to focus on. And we've got a new buzzword, recalibration. It was mentioned no fewer than 8 times during his comments. And what I really see when he brings up recalibration is maybe pivoting to really focusing on employment. Because right now we're getting really close to that inflation target. And during his comments, he made a reference to seeking maximum employment. And he mentioned that the central bank is willing to be aggressive in the next few months or even the next year if the data that comes in is not positive for employment. So what I gathered from those comments were most likely there'll be some 25 basis point cuts coming up in the next few months, but don't be surprised if we go back to 50 if the data that comes in for employment is not positive or what they're looking for.
Great. Matt, let's switch gears here because in 6 weeks, we have a huge election in this country. And there is a lot of talk about taxes, in particular, capital gains tax. What's all the discussion about?
What's all the hubbub?
Scott, taxes, can't avoid them. So let's first define what a capital gains tax is. It's a tax paid by an investor upon selling their asset based on the amount by which the asset appreciated during the time it was held. So think about an asset. It could be a stock, real estate, or even a collectible. But the key here, it has to be realized. It has to be sold. And right now, the current situation with the IRS in 2024 is your taxable income affects what your capital gains tax rate could be if it's held more than 1 year. So we're going to skip less than 1 year, which is ordinary income. But if it's held over 1 year, it could be 0, 15, or even up to 20% could be your capital gains tax rate. On top of that, you could have another 3.8% tacked on. That is called a net investment income tax, and that's based on your modified adjusted gross income if that goes over a certain threshold. So capital gains is very important with investors and understanding the tax consequences because it could have a huge impact on their overall savings. What about you, Scott?
All right, Matt, you know how much I love political questions, and you know how much I loved preparing for this one.
Yeah.
Right.
So I'm going to try and keep this as level as I possibly can, because both candidates do have opposing views when it comes to taxes. Surprise, surprise there. The Harris approach, what they're looking at doing is taxing investments similar to wages. Yes. So your investments out there where you have capital gains, whether they're realized or unrealized, the Harris administration is looking at a progressive tax equalizing income with investments. What they're also trying to do is equalize labor and investments for corporations. It is all about trying to equalize the tax code, whereas the Trump approach is all about lowering the capital gains tax, which they did do during his presidency in 2017 with the Tax Cuts and Job Acts. They brought long-term capital gains from 20% down to 15%. So they are proposing further cuts, and what their philosophy is furthering investments in our economy by lowering taxation. So yes, there are contrasting views. Harris wants to increase capital gains tax for wealthier Americans, focusing on equalizing the tax burden. Trump wants to lower that same capital gains tax to encourage investments. They are on opposite ends of the spectrum.
Scott, great job trying to pull both together. There's a lot going on there. So yes, we made up this rule. It's got to be within 1 minute just to put pressure on ourselves. So we're going to go back, though, to rate cuts because it was historic. And Scott, moving forward, when it comes to your portfolio management, what changes are you considering within your investment management approach?
Okay, so when the Federal Reserve cuts rates, portfolio management strategies should absolutely be affected, and you need to go back and look at your approach because you're in a completely different environment. The number one thing that I would recommend either investment managers or clients to do is to reassess your risk tolerance. It's the first thing that should be done. You want to understand the reasons for the cut. Is there economic weakness? Is there an upcoming recession in the near term? These questions will help investors adapt their investment philosophy. However, maybe it's not an upcoming recession. Maybe the Federal Reserve is looking to stimulate growth, in which case, in the short term, you would probably want to be going all in on risk and equities because that is going to be stimulated by lower rates. The cost of borrowing goes down to the consumer and to the businesses. There is an incentive for businesses and consumers to spend when rates are lower. So when you're looking at your asset allocation in the short term, in a tactical approach, owning growth, owning equities, as you look out down the road, you probably want to have a little bit more of a conservative approach, income producing investments like utilities and REITs, defensive areas like healthcare. These are going to be the areas that will protect you if there is economic weakness when the Federal Reserve continues to cut rates. Hope I was able to get that in there on time.
You just missed the cut.
You never do, but great job pointing that out. And that was the investment side. Planning side, I want to make clear here that as the rates are coming down from the Fed, there'll probably be a trickle-down effect gradually. And what's really been hurting investors in the past few years is borrowing. And you look at your home equity line of credit, credit cards, auto loans, mortgages. Seeing this, you can see those rates will gradually come down. Just for example, credit card borrowers, just over the last year, 9% of those balances have gone delinquent, which is the highest percentage in over a decade. So this is an opportunity for also investors to refinance if rates are coming down. But on the other hand, we're looking more longer out. We've seen this with clients already that may be locking in more to a longer term treasury bill or CD because that 5+% they were earning is probably coming down, or they're starting to see some short-term effects in money markets, savings accounts where interest is still high over the last 10, 15 years, but it's going down from where it was even the last 3 to 6 months. So there's definitely things to discuss when we're in these planning meetings with our clients.
Deep conversations, Matt. I agree. But let's switch gears again. I want to talk a little bit about emotions and behavioral finance. And clients and asset managers, they exhibit these biases. What do you see from our clients when it comes to some of the emotional and behavioral pitfalls that clients fall into?
Scott, loaded question, and I'm just going to focus on two areas because we got 1 minute. FOMO, fear of missing out, number one. Clients, based on their cash flow and projections, have an opportunity to buy a home. But on the back end, they're going to sacrifice some of their financial workout. We see this happen a lot where we have to talk to clients to make that decision because they want to get into something that in the long run may prevent them and even prevent them from investing or becoming even house poor. Also, having the opportunity to get into investments where they may have to borrow. Robbing Peter to pay Paul is a way you could look at it. We really see that a lot with clients because they don't want to miss out on opportunities. Another example of a pitfall is cash drag. Clients become comfortable in love with their apps, their bank statements, seeing cash in their bank account where with inflation, that money is really deteriorating its value over time, especially in the last few years. Even moving into a savings or money market has been an opportunity to earn more yield or interest on your account. But clients really get hung up on keeping their money in their bank account because that's where they are comfortable. What about you, Scott?
Matt, behavioral investing, it arises from cognitive and emotional biases that investors and managers exhibit. I just want to briefly go through what I perceive to be the top four. Number one is overconfidence. Managers and investors think that they have knowledge that the market doesn't, and they could beat the market. Time and time again, they're just flat out wrong. Second is loss aversion. We see this often where we look at client statements and they're simply holding on to losers too long, and they're also cutting those winners too soon. So that would be a bias that we clearly want to avoid, of holding on to those investments that we should have moved on from earlier. Third would be the recency bias. And this is right now in this market when investors believe that the recent past is going to continue into the future. An example would be the semiconductors and the chip makers continuing to have supernormal growth in perpetuity. Lastly, the confirmation bias. It's amazing how many times we speak to investors and managers who are researching information that simply confirms their original hypothesis. And that's not the way you want to be researching investment tools. You want to be looking at it from a clean blank canvas where you're equally looking at positive news and negative news, not just news that confirms what your original belief was.
Great stuff. Great points. I think we got a lot in here. This is a crazy time with the market. It's a crazy time with elections, interest rates. Scott, anything else you want to add?
No, investors, stay safe, stay the course. You're in a volatile market still. Volatility's not over. From what we're seeing, I would continue to be vigilant.
Awesome. Well, let's wrap this up. And investors, remember, stay focused, stay disciplined, and stay tuned for the next episode of The Bash.